The year is 2008. The air smells like burnt coffee and pure, uncut panic. A guy in a crisp, now rumpled suit walks out of a glass tower in New York, holding a cardboard box. Inside, a dead plant, a stapler, and a picture frame. His company, Lehman Brothers, a 158-year-old titan of finance, has just evaporated. The global financial system, the one we're told is managed by the smartest people in the room, is holding its breath. And then it flatlines. We were all told it was a once-in-a-lifetime crash, caused by subprime mortgages, shady loans given to people who couldn't possibly afford them. And that's true, but it's a convenient, bite-sized lie. The bad mortgages were just the match, the explosion. The thing that turned a few $100 billion in housing losses into a $20 trillion global meltdown that cost 9 million Americans their jobs was something else. Something you've heard of, but probably can't explain at a dinner party without everyone's eyes glazing over. Derivatives. That number? That's the high-end estimate for the notional value of the entire global derivatives market right now. 1.5 quadrillion. That's a 15 with 14 zeros. It's a number so cosmically large your brain can't even process it. It's more than 15 times the entire planet's GDP. The financial weapon of mass destruction that blew up the world in 2008 was never defused. The banks just got a slap on the wrist, took our bailout money, and then went right back to building a bigger, shinier, and far more complicated bomb right on top of the old one. And the trigger for that bomb? It might have already been pulled. Today, we're prying open the black box. We're going to look at the financial time bomb ticking under your feet and why the next 2008 could be infinitely worse. 1. So, what the hell is a derivative anyway? Host. Alright, let's get this out of the way. The word derivative is intentionally boring. It's Wall Street camouflage. Bankers want you to think it's too complex for your tiny civilian brain. It's not. A derivative is just a contract. It's a bet. That's it. Its value is derived from something else, an underlying asset. Here's the simplest example. You and your buddy bet $50 on the Super Bowl. The game is the underlying asset. Your $50 bet is the derivative. You didn't buy a team, you didn't buy a player. You just made a contract that pays out based on the outcome of the game. Finance is just a glorified casino. Now, derivatives aren't inherently evil. They were invented for a logical reason: managing risk. The classic example is a farmer. Imagine you're an orange farmer in Florida. It's March. Your harvest is in September. You're terrified of a hurricane, or a sudden frost, or Brazil suddenly dumping 1 billion oranges on the market, crashing the price. You need to know you can sell your oranges for, say, $10 a crate, or you go bankrupt. Meanwhile, across the country, the CEO of Tropicana is also terrified. He's worried about a drought, which would skyrocket the price of oranges to $20 a crate and kill his profit margin. So, you two make a derivative called a futures contract. You, the farmer, agree to sell 100,000 crates of oranges in September for $10 a crate. The Tropicana CEO agrees to buy them at that price. Boom. Done. You both just hedged your risk. You gave up the chance of making more money if prices go to $20, but you guaranteed you won't go broke if prices fall to $5. The Tropicana CEO did the opposite. Everyone sleeps better. This is the responsible adult version of derivatives. But this is Wall Street. And Wall Street can't just leave a useful tool alone. It has to turn it into a high-stakes, unregulated casino. Now, in walks a third guy. Let's call him Chad. Chad works at a hedge fund. He wears a Patagonia vest over a dress shirt. Chad has never seen an orange tree. He doesn't make juice. He doesn't care about oranges. Chad just thinks he knows which way the price of oranges will go. So Chad starts buying and selling your futures contracts from other speculators. He's not hedging, he's speculating. This is where the problem starts. Suddenly the market for bets on oranges becomes 1,000 times larger than the market for actual oranges. The tail is now wagging the dog. And here's the kicker, the concept that underpins the entire time bomb: leverage. When Chad makes that bet, he doesn't have to put up the full price of 100,000 crates of oranges. Hell no. He just has to put up a tiny fraction, like 5% or 10%, as margin or collateral. So with just $50,000, Chad can control a $1,000 position in oranges. If the price of oranges moves just 5% in his favour, he doubles his money. He's a genius. He's ordering bottle service. But if It moves 5% against him, his entire $50,000 is gone, wiped out. Now, scale that up. Instead of $50,000, Chad's fund is betting $50 billion. And they're not just betting on oranges. They're betting on the price of oil, the stock price of Apple, the interest rate of Japan, the currency of Turkey, anything. The three main flavours of this poison are futures, the orange contract. You must buy or sell something at a set price on a set date. Options. This gives you the option, not the obligation, to buy or sell. I can buy your 1,000 shares of Tesla at $180 in June, and for that right I'll pay you a small fee now. Swaps. This is the really freaky one, the trading spouses of finance. It's a contract where two parties swap cash flows. You pay my variable rate loan interest and I'll pay your fixed rate loan interest. This seems innocent. It is not. As we'll see, swaps are the darkest, most opaque and largest part of this entire market. They are the C4 packed around the foundation of the global economy. So to recap, a derivative is a bet. Leverage lets you make $1 billion bet with $1 million money. And the market is almost entirely run by speculators, not farmers. What could possibly go wrong? 2. The 2008 trailer. How a bunch of mortgages blew up the world. So if derivatives are just bets, how did they cause the 2008 meltdown? Oh, my sweet summer child. You see, the bankers got creative. They didn't just bet on oranges, they started betting on debt. The vibe in the early 2000s was get rich or die trying. Interest rates were at rock bottom. Everyone wanted a house. Banks were happy to oblige, handing out subprime mortgages to, well, everyone. Got a job? No. Pulse? Faint? Here's a $500,000 loan. Don't worry about it. The banks weren't stupid. They knew these loans were ticking time bombs, so they decided to sell them. But how do you sell a box of radioactive waste? You securitize it. They took thousands of these trash-tier mortgages, and maybe a few good ones to dilute the poison, and threw them all into a financial blender. They called this smoothie a mortgage-backed security, MBS. Then they went to the ratings agencies, Moody's, Standard & Poor's, and said, hey, if you blend 1,000 pieces of junk together, it's diversified, right? It's basically impossible for all of them to fail at once. The ratings agencies, which were paid by the banks, hello conflict of interest, said, you betcha, and stamped this toxic sludge with a AA rating, the highest possible, safer than government bonds. Pension funds, town governments, and European banks bought trillions of dollars of this stuff thinking it was as safe as gold. But this isn't even the derivative. This was just Act 1. Act 2. The Collateralized Debt Obligation, CDO. This is where the mask-off villainy begins. The banks took the worst parts of the first smoothie, the tranches, slices, that were already known to be risky, and reblended them into a new smoothie. I'm not kidding. This is like taking the leftover grease and gristle from 10 different McDonald's, pressing it into a new steak, and calling it filet mignon. And the ratings agencies also stamped this with a AA rating. This is what The Big Short was about. A few weirdos like Michael Burry looked at this and said, wait, you're building castles on a foundation of quicksand, this will collapse. But how do you bet against a housing market? Enter the true weapon, the Credit Default Swap, CDS. A CDS is just an insurance policy. Let's say you're a pension fund and you own that $10 million filet mignon CDO. You're a little nervous. So you go to an insurance company like AIG, American International Group, and you buy a CDS. You pay AIG a small fee every month. If your CDO fails, i.e. all the homeowners stop paying their mortgages, AIG pays you the full $10 million. So simple, right? Insurance. Except for two tiny civilization-ending loopholes. Loophole number 1. You could buy a CDS on a CDO you didn't even own. Think about that. This is like me buying fire insurance on your house. I have no connection to your house. I just pay $100 a month to an insurer. If your house burns down, I get paid $500,000. What am I? Suddenly, I'm a guy who is actively rooting for your house to burn down. This is what Michael Burry and the other shorters did. They went to the banks and started buying fire insurance on all the houses they knew were built of gasoline-soaked cardboard. Loophole number 2. Anyone could sell this insurance. This is the one that killed the world. When you buy car insurance from Geico, Geico is regulated. They have to keep a big pile of money, reserves, in a vault, just in case all their drivers get in a wreck on the same day. AIG didn't. They were selling these insurance policies in the dark, unregulated, over-the-counter OTC market. For every policy AIG sold, they just pocketed the premium. They booked it as pure 100% profit. They kept $0 in reserve. Why? Because their internal models, built by quants, math PhDs, said a nationwide housing collapse was statistically impossible. It had never happened. It was like a single guy selling earthquake insurance to every single homeowner in San Francisco, while simultaneously claiming earthquakes are a myth. He's collecting billions in free money. He's the richest, smartest guy in the world. Until the ground starts to shake. In 2007, the ground started to shake. The subprime mortgages, built on 2-year teaser rates, all reset at once. Homeowners couldn't pay. They defaulted. The unlosable MBS and CDOs started to fail. Everyone who had bought fire insurance in the CDS from AIG all ran to the front desk at the same time and yelled, "Pay up! The world is on fire!" And AIG opened its wallet and found nothing. Moths. IOUs. They owed hundreds of billions of dollars to every major bank on the planet. Goldman Sachs, JP Morgan, banks in Germany, France. This is called counterparty risk. It's the moment you realize the insurance you bought is just a worthless piece of paper written by a bankrupt moron. If AIG failed, all those other banks would instantly fail, because the insurance on their books, which they counted as an asset, was now worthless. It was a chain reaction, a domino line. And that is why the government stepped in. They didn't bail out the homeowners. They gave AIG $182 billion of your money. They bailed out the bookie so the other casinos wouldn't have to admit their chips were fake. The mortgages were the symptom. The derivatives, the CDOs built on trash, and the CDSs betting on them were the disease. And that, my friends, was just the trailer. The main feature is about to start. 3. Volmageddon, the day we blew up calm. Okay, so in 2008, the bomb was built from something tangible, bad mortgages. You could, in theory, drive by the empty houses in Nevada and see the rot. But since then, the bankers, in their infinite wisdom, decided to bet on things that are completely intangible. They started betting on ideas. Ideas like calm. I'm not kidding. They figured out a way to monetize the absence of panic. You need to know about the VIX. It's the volatility index. Wall Street calls it the fear gauge. Basically, when the market is calm, steady, and slowly rising, like it was for most of 2017, the VIX is super low. It's asleep. But when the market starts to panic, when it drops fast and erratically, the VIX explodes. It's the hockey mask-wearing psycho in the closet of the stock market. For years, the VIX just stayed low. After the 2008 crisis, central banks pumped the world full of free money, what they call quantitative easing, and this acted like a powerful sedative on the market. It was a risk-free environment, and whenever there's a sure thing, Wall Street creates a product so you can bet on it. Enter the short volatility trade. This was a bet that calm would continue. It was quite literally a bet that nothing bad would happen tomorrow. The most popular products for retail investors, that's you, were ETNs, or exchange-traded notes. The most famous one was called Fürstient. Fürstient was essentially a derivative of a derivative. It was a bet on VIX futures. Stay with me. It was an inverse note. This means that every day the VIX stayed low or went lower, this thing made money. And from 2016 to early 2018, it printed money. It was the free money cheat code. People were piling into this thing. Hedge funds, but also dentists and IT managers and retirees who read a blog post. They were all selling calm. They were selling earthquake insurance in a town that hadn't had a tremor in a decade. They were pocketing the premium every single day, feeling like geniuses. And then came February 5th, 2018, a day that financial nerds call Volmageddon. It wasn't even a crash. It was just a bad day, a really bad day. The Dow Jones fell about 4.6%. People were spooked about inflation, about interest rates rising. But here's the problem. Everyone was on the same side of the selling calm boat, and that 4.6% dip was the equivalent of a rogue wave. The VIX, the fear gauge, woke up, and it was pissed. In a single afternoon, the VIX spiked 115%. It was the single biggest one-day jump in its entire history. Now, remember how Fürstient and these other products worked. They were inverse and leveraged. They were shorting VIX futures. When the VIX spiked, all of these products broke. They had a built-in mechanism. To cover their catastrophic losses from the VIX exploding, their own internal rules forced them to buy VIX futures, the very thing that was exploding. This is a feedback loop from hell. It's like being short on gasoline, and then a fire breaks out. Your contract forces you to run into the fire and buy all the gasoline you can find, which of course just makes the fire infinitely bigger. At 4 p.m, the market closed. The S&P 500 was down, but it wasn't dead. It was a survivable wound. But in the after-hours market, this Rube Goldberg machine of derivatives started to self-destruct. The computers running these funds realized they were insolvent. The 14th note, which had traded at $180 a share that morning, was now worth nothing. In one afternoon, over $3 billion in investor value was annihilated, wiped from existence. The next morning, Credit Suisse, the bank that issued the note, just terminated it. They posted a press release that basically said, "Thanks for playing, your money is gone." People who had their entire retirement in this free money trade were zeroed out. There's a now famous Reddit thread from that day. One guy posted a screenshot of his $4 million E-Trade account. His current value, $168,000. Another user, a 30-year-old, posted about losing $50,000, writing, "I'm broke, I've got nothing. I'm going to be a wage slave for the rest of my life." Volmageddon was a warning shot. It proved that the plumbing of the market is now so complex, so layered with derivatives on derivatives, that a normal bad day can trigger an instantaneous automated total collapse of an entire asset class. It wasn't a human panic, it was a computer panic, written in code, executing a death spiral faster than any human could react. And the scary part, your full thieves was a tiny niche product, a toy. Now imagine that same feedback loop, that same automated self-destruction, in a market that's 10,000 times bigger. You know, just talking about this stuff raises my blood pressure. If your blood pressure is also rising, or if you're just enjoying having your entire concept of financial security dismantled, do me a favour and hit that like button and subscribe. It's free, unlike the next bailout. We're all in this financial hellscape together, so you might as well join the community, and let me know in the comments what your biggest financial fear is. Student loans, housing, or the $600 trillion invisible monster we're about to talk about? Alright, let's get back to the nightmare. 4. The $600 trillion blind spot, Archegos and the total return swap. So after 2008, the world's governments got together and said, "Okay, that was bad. We should probably, do something." The big fix was the Dodd-Frank Act in the US. A key part of it was aimed directly at the derivative time bomb. The problem in 2008, you'll remember, was counterparty risk. AIG failed, and suddenly everyone was exposed. The bets were all private. Dodd-Frank's solution was to force these bets out of the dark. They wanted to push all these derivative trades onto central clearinghouses. A clearinghouse is just a central bookie. It stands in the middle of every single bet. If Bank B goes bankrupt, it's the clearinghouse's problem, not Bank A's. This is supposed to contain the fire. It also means regulators can see the bets being made. It was a good idea, the banks hated it. They live in the dark. Darkness is where they make their money. It's called the over-the-counter OTC market. It's not an exchange. It's a gentleman's agreement between two giant banks, done over a recorded phone line and a 300-page legal doc. So, the banks lobbied. Hard. And they got a ton of exemptions. And they funneled their riskiest, most profitable bets right through those loopholes. The market remained in the dark. We had no idea who was betting on what, or how big their bets were. We were completely blind. And we didn't find out how blind we were until March 2021. Meet Bill Hwang. In the early 2010s, Hwang ran a hedge fund called Tiger Asia. He was caught for insider trading in China and forced to shut down. He pleaded guilty to wire fraud in the US and paid $44 million in fines. You'd think this guy would be banned from touching money forever, right? Wrong. He just reopened. This time, he called his fund Archegos Capital Management, but he set it up as a family office. This is a crucial distinction. A family office manages one family's money, his. And because of that, it's exempt from almost all the SEC regulations that hedge funds have to follow. He didn't have to report his holdings, he didn't have to disclose his risk. He was a ghost. And Bill Hwang had an appetite. He was insanely bullish on a very small handful of stocks. Things like Viacom CBS, now Paramount, Discovery, and some Chinese tech stocks. But he didn't buy these stocks. If he did, he'd have to put up all the money. And the second he bought 5% of a company, he'd have to file a form with the SEC, announcing his position to the world. He didn't want to do that. He wanted to be a ghost. So he used a specific type of OTC derivative, the total return swap. Here's how it works. It's devious. Huang walks in to say Credit Suisse and says, "Hey, I want to bet on $10 billion of Viacom stock, but I don't want to buy it. You buy it. You hold it on your books. I'll pay you a small fee." Credit Suisse says, "Okay, what's in it for us?" Huang says, "We'll swap the return. If the stock goes up 10%, you pay me $1 billion. If the stock goes down 10%, I pay you $1 billion, and this is pure leverage. With maybe $1 billion in collateral, Huang could get $10 billion in exposure. But here's the sociopathic kicker. Bill Huang didn't just do this with Credit Suisse. He went to Morgan Stanley and made the exact same bet. Then he went to Nomura, and Goldman Sachs, and UBS, and Deutsche Bank. None of them knew about the others. This is the dark market. Credit Suisse thought they were the only ones on the hook for Huang's bet. They thought his $10 billion position was manageable. They had no idea. His total position was over $100 billion. He had leveraged a $10–15 billion family office into a $100+ billion monster. He secretly became one of the largest shareholders in all of these companies without owning a single share. It was the perfect, invisible machine. Until March 22nd, 2021. Viacom CBS announced a new stock offering to raise cash. The market didn't like it. The stock just wobbled. It dipped. Not a crash, just a dip. But for Bill Huang, who was leveraged 10-1, a small dip is a catastrophe. All his bookies, Credit Suisse, Goldman, all of them, got an automated alert. Huang's bet was underwater. He was in default. And all at the same time, they all picked up the phone. It was the dreaded margin call. "Bill? Yeah, hi, it's Credit Suisse. Your Viacom bet is down. We need $3 billion by noon." "Bill? Morgan Stanley. Yeah, we need $2 billion. Wire it now." Bill Huang had nothing. He was wiped out. And the banks panicked. They realized they were the ones left holding the bag. They were the ones who actually owned $100 billion of a stock that was now in freefall. What followed was a scene straight out of Reservoir Dogs, a back-alley brawl. Goldman Sachs and Morgan Stanley, sniffing a problem, acted first. They held a fire sale. They dumped billions of dollars of their Archegos-linked shares onto the open market immediately. They took small losses, but they got out. But Credit Suisse, and Nomura, they hesitated. They thought, maybe we can unwind this slowly without crashing the price. They were wrong. By the time they tried to sell, the price had already collapsed. The final tally was staggering. Credit Suisse lost $5.5 billion. Nomura, Japan, lost $2.9 billion. Morgan Stanley lost $911 million. Archegos, a single family office, caused over $10 billion in losses for the world's biggest banks. Banks that are supposedly too big to fail and have world-class risk management. Their risk management didn't account for the fact that their competitors were all taking the same guy's bet. And here is the real terror. The collapse of Credit Suisse, a 167-year-old, systemically important global bank, in March 2023, can be traced directly back to this. The $5.5 billion loss from Archegos, combined with another derivative scandal called Greensill, shattered market confidence in the bank. It was the wound that never healed. 2 years later, the bank was dead, forced into a shotgun wedding with its rival UBS. A single, unregulated gambler, using an invisible derivative, killed one of the 30 most important banks on Earth. The Bank for International Settlements, BIS, the central bank for central banks, estimates the total notional value of the dark OTC derivative market is $618 trillion as of late 2023. Archegos was just one guy. How many other Bill Huangs are out there who has secretly leveraged 100-1 on German real estate, or Japanese government bonds, or Tesla stock? We have no idea, and we won't know until the margin calls start. 5. The Empty Skyscraper and the Big Short 2.0. Alright, let's take a breath. What we've discussed so far, Volmageddon, Archegos, these were accidents. They were flashes of lightning that revealed the storm. But what if there's a storm we can all see coming? A Category 5 hurricane spinning just offshore with meteorologists on TV calmly telling us it's just a light breeze. It's 2024. You're walking through downtown San Francisco, or Chicago, or Lower Manhattan, and it's quiet. Too quiet. The skyscrapers are still there, glittering in the sun, but they're hollow. They are beautiful, $500 million tombstones. The COVID-19 pandemic didn't just change how we feel about masks. It fundamentally broke the concept of going to the office. I can do my job in sweatpants from my couch. Your boss. Holy hell, I can save $20 million a year on rent and my stock price will go up. This work-from-home revolution is not a social trend. It is the single greatest revaluation of an asset class in our lifetime, and that asset class is commercial real estate, CRE. And it's the trigger for the exact same bomb we saw in 2008, just with a slightly different flavour. Remember the mortgage-backed security, MBS, the toxic smoothie of bad home loans? Meet its sociopathic older brother, the commercial mortgage-backed security, CMBS. It's the exact same playbook. For decades, banks have taken thousands of loans for office towers, for shopping malls, for apartment complexes, for hotels, and bundled them into a CMBS, gotten the corrupt ratings agencies to stamp it TLA, and sold it to the exact same suckers. Pension funds, insurance companies, and foreign investors who need a safe place to park their cash. And just like 2008, the loans inside these bundles are, well, let's call them optimistic. Here's the problem. Those loans, unlike your 30-year home mortgage, are not built to be paid off. They are typically 5, 7 or 10-year balloon payments. This means for 10 years, a building owner, like say the guy who owns that 50-story glass tomb, just pays the interest. He's not paying down the loan. At the end of 10 years, the entire loan, let's say $400 million, is due, all at once. The plan was never to pay it. The plan was always to refinance. You just go to a new bank, show them your building is full of tenants paying high rent, and get a new $400 million loan to pay off the old $400 million loan. It's the financial equivalent of kicking the can down the road. And from 2012 to 2022, with interest rates at zero, this game was easy. Welcome to the refinancing wall. Between now and the end of 2026, over $2.2 trillion of this commercial real estate debt is coming due, and the world has changed. Two things are happening at the exact same time. Thing number one, the underlying asset is worthless. That $400 million building, which was 98% occupied in 2019, is now 40% occupied. WeWork, its main tenant, is bankrupt. The coffee shop in the lobby is gone. It's a ghost town, so when the owner goes to a bank for a new loan, the bank says, "Are you insane? This building isn't worth $400 million, it's worth $150 million if we're lucky." Thing number two, the cost of the loan has exploded. The old loan had an interest rate of say 3%, but now the Federal Reserve has cranked rates to fight inflation. That new loan, if he can even get it, will be at 8%. The owner is trapped. He has to pay off a $400 million loan. He can only get a new loan for $150 million, and his payments on that new, smaller loan will be higher than his old, bigger loan. It is mathematically impossible for him to pay. So what does he do? He does what every logical, sociopathic corporation does. He jingles the keys. He mails the keys to the building back to the bank and says, "It's your problem now." This is called a default. This isn't a what if. It's already happening. In 2023, the owners of the Owen Center, the third tallest building in San Francisco, just gave up, defaulted. A massive office portfolio in Los Angeles, defaulted. Blackstone, the biggest CRE player of all, defaulted on a $562 million CMBS for an office park in New York. This is the beginning of the avalanche. But, you ask, your eyes wide with innocent terror, how does this become a derivative bomb? Oh, because it's not the first domino that matters, it's the 10,000 dominoes behind it. Domino 1, the CMBS fails. All those pension funds and insurance companies who bought the KI-rated security, it's now worth pennies on the dollar. Your retirement fund, the one you never look at, it just took a 30% hit. Domino 2, the banks. Who holds the rest of this $2.2 trillion in debt? The big banks, JP Morgan, BofA, are too smart. They sold it all off. The holders are the regional banks, Silicon Valley Bank, Signature Bank, New York Community Bancorp. These are the banks that actually gave the loans to the building owners. They are now holding hundreds of billions of dollars in bad paper. This is why a bunch of them already failed in 2023. That was the pre-shock. Domino 3, the real bomb, the credit default swap, CDS. Remember AIG? Remember fire insurance on a burning building? It's back. For the last 5 years, a whole new generation of big short investors have been aggressively buying CDS insurance on these specific CMBS bundles. They are betting on the collapse. This means someone is on the other side. Someone is selling that insurance. Someone is playing the role of AIG. Someone, probably a different pension fund or a European bank or another hedge fund, is looking at this hurricane offshore and saying, "I'll bet you 10 billion it doesn't make landfall just to collect the free premium. We have no idea who is on the hook." This is the Archegos scenario all over again, but not with one company, with an entire asset class. When that $2.2 trillion wall of debt hits and the defaults cascade, all of those big short investors are going to turn to their counterparty and they're going to say, "Pay up." And that counterparty, which has been leveraged 100 to 1, will open their wallet and find nothing. And the real crisis begins. The real contagion. The one that freezes the entire global credit system. The one that forces the Federal Reserve to choose. Do they bail out every single regional bank, pension fund and insurance company? Or do they let the entire system, the real economy, go cold? The 2008 bomb was built on the idea that house prices always go up. The 2025 bomb is built on the idea that people will always go to the office. Both are lies, and the second lie might be even bigger. 6. The ZDTE casino, weaponizing the S&P 500. If the CRE crisis is a slow motion, we can all see it coming catastrophe. The final bomb we're going to talk about is the opposite. It's an instantaneous catastrophe. A flash crash so fast, your human brain can't even process it. Welcome to the final boss of the financial casino, Zero DTE options. That stands for 0 days to expiry. Let's go back to our options definition. An option is the right to buy a stock at a set price on a set date. For decades, these expiry dates were predictable. They were monthly or quarterly. You bought an option on Apple and it expired in, say, 30 days. This gave you time to be right. It was a strategy. But in 2022, the exchanges, the CBOE specifically, had a brilliant idea. They thought, what if investors are too patient? What if we could get them to gamble faster? So they introduced DTE options for the S&P 500, the bedrock of the entire market. These are options, contracts that are born in the morning and die at 4 p.m. the same day. This is not investing. This is not hedging. This is sports betting. It is putting $1,000 on red at the roulette wheel at 9:30 a.m. and finding out if you've doubled it or lost it all by 4 p.m. And everyone is doing it. In just 2 years, these lottery tickets have grown to $1 trillion in notional value every single day. That's a $1,000 casino, opening and closing every 8 hours. This creates a new kind of bomb. We're not worried about counterparty risk here, like Archegos. We're not worried about asset risk, like CRE. We're worried about structural risk. We've built a doomsday machine that could accidentally tear the entire market apart. Here's how. This bomb has a name, Charm, or more specifically, Gamma Squeeze. I know, more Greek letters, it's camouflage again. But this is the most important one. The Greeks are just variables that options traders use. Gamma measures how fast an option's price changes. The sellers of these DTE options are not gamblers. They are giant institutional banks and market makers. JP Morgan, Citadel Securities. Their job is to be the house. They are the casino. They don't want to bet. They want to be delta neutral. They just want to collect the premium, the fee from the gambler. To stay neutral, every time they sell a call option, a bet the market goes up to a gambler, they have to immediately go out and buy a little bit of the actual S&P 500 just to hedge their own bet. This is automated. A computer does it. Now, imagine a normal day. A good economic report comes out at 10 a.m. The market inches up 0.2%. What happens? $1 billion worth of degen retail traders, all sitting at home, all see the green, and they all pile into 0DTE call options at the same time. They're all betting market goes up. What does the market maker, the casino, have to do? Their computers instantly say, danger, we are short. We just sold $1 billion up bets. Hedge, hedge, buy, buy, buy. 1. Retail gamblers buy call options. 2. Market makers are forced to buy the S&P 500 to hedge. 3. This buying pushes the S&P 500 higher. 4. Which makes the call options more valuable. 5. Which makes more gamblers pile in. 6. Which forces the market makers to buy even more. 7. Loop. This is the gamma squeeze. It's the tail, the $1 trillion daily casino, wagging the dog, the $40 trillion US stock market. This is why you see the market, for no reason at all, suddenly rocket up 1% in the last hour of the day. It's the charm effect. The computers are all buying. But what happens when that loop goes down? Imagine a bad day. A single, scary rumour. A bank fails. A geopolitical event. The market dips 0.5% at 10 a.m. The gamblers, they all pile into put options. I bet the market goes down. What does the market maker's computer have to do? To hedge this bet, it has to sell. 1. Retail gamblers buy put options. 2. Market makers are forced to sell the S&P 500 to hedge. 3. This selling pushes the S&P 500 lower. 4. Which makes the put options more valuable. 5. Which makes more gamblers buy more puts. 6. Which forces the market makers to sell. Even more. 7. Death spiral. This is the Volmageddon scenario from 2018, but on the S&P 500 itself. It's an automated, algorithmic, instantaneous crash. A flash crash. We have no idea if the plumbing can handle this. We have built a $1 trillion daily casino on top of the main stock market, and we have linked them with an automated self-destruct switch. JP Morgan, one of the creators of this market, released a report. They estimated that a single-day drop of 4%, which we saw in 2020 and 2018 and 2008, could force these automated systems to sell $30 billion of the S&P 500 all at once. That level of selling would trigger other automated systems, like risk parity funds, which would also sell. It's Volmageddon 2.0. And the underlying asset isn't a niche VIX product, it's everything. It's your 401k. 7. The everything, everywhere, all at once. Crisis. Okay, let's bring it all home. Let's connect the dots and look at the final picture, because it's not one of these things that's going to cause the crash. It's the fact that they could all happen at once. In 2008, the crisis was elegant. It was singular. It was one thing, the US housing market. The derivatives, MBS, CDO, CDS, were all just different-sized chainsaws pointed at the same tree. When that one tree fell, it crushed the whole forest. It was a monocausal failure. And the solution, while costing us our souls, was simple. Bail out the one thing, AIG, that connected all the banks and flood the world with 0% interest money. What we are facing now is not one tree. We are facing 3 or more completely independent, massive-scale crises, all bubbling at the same time. Crisis 1. The 2008 sequel, commercial real estate. This is our slow-motion, visible, big short scenario. It's a $2.2 trillion time bomb, and the defaults are already happening. This is a solvency crisis. It is a direct mortal threat to the regional banking system, who holds the loans, and the pension system, who bought the OAE at ACMBS. This bomb will take months or even years to fully detonate. Crisis 2. The flash crash. 0DTE options. This is our algorithmic instantaneous bomb. It is not a solvency crisis, it's a structural crisis. It's a $1 trillion per day casino that has been bolted onto the side of the S&P 500 with an automated feedback loop that could trigger a gamma death spiral at any moment, for any reason. This bomb doesn't take years, it takes 30 minutes. Crisis 3. The invisible ghost. OTC swaps and counterparty risk. This is our Archegos scenario, scaled up to infinity. This is the 618 trillion dark matter of finance. We have no idea who is leveraged 100 to 1. We have no idea who is holding the bag from a Bill Hwang 2.0. This is a counterparty crisis. It's a crisis of trust, where the entire system can freeze because nobody knows if the insurance they bought is actually worth anything. It's a Tuesday. A bad report on commercial real estate vacancies comes out. The market was expecting it. But it's just bad enough that 2 regional banks in New York announced they're halting withdrawals. This spooks the market. The S&P 500 drops 1.5% in the morning. The degen gamblers in the DTE market see this. They all pile into put options, betting on a further collapse. This triggers the gamma death spiral. The market makers are forced to sell, and sell, and sell. By 2 Sol PM, the 1.5% drop is now a 4.5% drop. It's a flash crash. Now, somewhere in a glass tower, a hedge fund, let's call it Omega Capital, was secretly leveraged 50-1 on, who knows, maybe German government bonds. But they were using S&P 500 stock as their collateral. The flash crash vaporizes their collateral. Their prime brokers, the banks, just like with Archegos, all margin call them at the exact same time, Omega is dead. They can't pay. And it turns out, Omega was the insurance for dozens of other players in the $600 trillion OTC market. Suddenly, Credit Suisse 2.0 is happening. A major European bank reveals it has $20 billion in exposure to the failed Omega fund. Do you see? It's the everything, everywhere, all at once crisis. The CRE bomb, Crisis 1, triggers the ZeroDTE bomb, Crisis 2, which exposes the OTC bomb, Crisis 3. The entire financial system, your bank solvency, market structure, and counterparty trust all fail at the same time. And here, my friends, is the punchline. This is the real reason the next crash will be worse. The Fed has no bullets left. In 2008, when the world ended, the Federal Reserve had a magic wand. Interest rates were at 5.25%. To fix the crisis, they just cut them. Cut, 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 all the way to zero. And then they printed $4 trillion, quantitative easing, to buy up all the bad bonds. It was a bazooka of free money. It drugged the patient, stopped the bleeding, and inflated a new everything bubble for 15 years. Now, what happens when our scenario hits? In 2024, to fight the inflation they caused with the last bailout, the Fed raised rates. So the crash, the everything crash, hits in a high-rate environment. The Fed now has an impossible choice. Choice A, do what they did in 2008. Cut rates back to zero. Print $10 trillion, it'll have to be bigger, to bail out the regional banks, the pension funds, and the S&P 500. The result, they might save the banks. But the US dollar, the thing in your wallet, becomes worthless. Inflation, which is already bad, goes to 20%. 30%. We're talking Weimar Germany. We're talking a wheelbarrow of cash to buy bread. You are saved, but your life savings are vaporized by inflation. Choice B, do nothing. Uphold their mandate to fight inflation. Keep rates high. Let the banks fail. Let the pensions fail. Let the S&P 500 burn. The result? They cure inflation, but they also trigger the second Great Depression. 25% unemployment, breadlines, the collapse of the global credit system, total unmitigated systemic failure. This is the time bomb. It's not just that the derivatives are bigger, faster, and darker. It's that the fire department is trapped in the burning building with us, and their water hoses are full of gasoline. The 2008 crisis was a question of how much money do we spend to save the banks? The next crisis will be a question of do we save the banks or do we save the dollar? And the terrifying secret is that they cannot do both. So, there it is. The bomb wasn't defused. It was just rebuilt with shinier parts, more complex wiring, and a bigger payload. We've built a system that incentivizes smart people to create weapons they don't understand, to hedge against risks that are caused by their own weapons. We've connected a 100-year-old regional banking system to a nanosecond fast algorithmic casino, and we've hidden all the IOUs in a $600 trillion dark closet, all while hoping the one building owner in San Francisco can make his balloon payment. It's a black comedy. And the punchline is, we're all in the audience and the doors are locked. Look, I'm not a financial advisor. This is not financial advice. Please, for the love of God, do not go and panic sell your 401k or buy a bunker. The entire point of this is that the system is, by its very nature, unknowable. Anyone who tells you they know what's going to happen is selling you something. The only moral here is that complexity is, itself, a risk. Leverage is a weapon, and free money is never ever free. Your only job as a normal person trying to survive this is to not be the sucker. Don't get leveraged. Don't fall for the free money cheat code like the Feasteam traders. Don't gamble what you can't afford to lose. Because the house is building bombs in the back room. Thank you for coming on this deeply stressful journey with me. If this video somehow didn't give you enough anxiety, you're going to love our other videos on the playlist. Check them out. And if you have an idea for a financial ticking time bomb I missed, let me know in the comments. I read all of them. Thanks for watching. Stay curious, stay skeptical, and good luck.